me start my. Very good afternoon to all of you and welcome in today's session on whether TRC, that is Tax Residency Certificate, is sufficient to claim DTA benefits in India or not. I am CA Gaurav Garg. Welcoming you in this session. At the outset, let me say many congratulations or warm wishes on the occasion of Baisakhi, which is today, and also remembering Dr. Bhimrao Ambedkar, who wrote our Constitution of India. So today we will be discussing whether tax residency certificate is sufficient to claim the tax treaty or double taxation avoidance benefit in India or not. I think, and it is important from the perspective of all three parties, which are linked in a transaction. Three parties: the one who will receive the payment, the non-resident. Second, the one who is making the payment, the taxpayer in India, maybe resident or maybe non-resident. And the third, which is very close to us, is a chartered accountant who might need to issue the form 146 with regard to whether the transaction is taxable, transaction is not taxable, whether to give DTA benefit or not. I think this session would going to be very useful for all these three stakeholders in the transactions. So historically, we will see, we have seen, when any transaction we see, whether we see when any transaction comes to us and we want to check whether the transaction is taxable in India or not. We start with Section 5 of the Act. We go to Section 9, then we see whether the taxpayer is giving us the treaty tax residency certificate or not. Kindly keep yourself on a mute mode. And if the TRC is given, the transaction is taxable, we give the DTA benefit. Now, after giving the DTA benefit, we deduct the tax and we issue Form 15 CB earlier and now Form 146. This is how things proceed. And at best, a chartered accountant, what he will take, okay, give me the tax residency certificate, give me Form 10F, give me no PE declaration certificate, some invoices, and that's it. And based on these documents, we evaluate whether to give the treaty benefit to the non-resident or whether we should not give the benefit to the non-resident of the tax treaty. And we know there is a very celebrated judgment by the Apex Court in the matter of Azadi Bachao Andolan, wherein the Mauritius treaty was analyzed and the treaty shopping was discussed, and the court said treaty shopping was very much allowed in India. And till now, many of us, knowingly or unknowingly, try to follow that judgment. We know, there could be a structure. For example, there is an entity, let's say in the Middle East, in the UAE, which is not doing any function, but yes, transactions are routed through that entity in Middle East, or there may be an entity in Singapore through which transactions are routed. So, and why only Singapore or Middle East? There could be entity in any part of the world which is not having employees or not having assets, but yes, we might be remitting them the royalty, or we might be remitting them the fee for technical services, or they might be holding some shares in Indian company. So this could be the possible structures or transactions which are happening. We are issuing the certificates stating that transaction is not taxable in India and giving them the treaty benefit, or giving them, because if you see, the tax rate under the Act when it comes to the FTS and royalty is 20%, whereas if we go to the tax treaty, the rate may be 10 or 15%. So we might be giving the benefit of the tax treaty based on the tax residency certificate, which is now not sufficient. So in this presentation, I would be giving you the overview of different regulations that we need to keep in mind in addition to tax residency certificate. So let me share my presentation. So we have section 90 subsection 4 in the old Act ITA 1961, which categorically lays down the requirement of tax residency certificate. It says an assessee who being a non-resident, who being a resident, not being a resident, to whom an agreement referred to in subsection 1 applies, shall not be entitled to claim any relief under such agreement unless a certificate of his being a resident in any country outside India or specified territory outside India, as the case may be, is obtained by him from the government. The assessee referred to in subsection 4 shall also provide such other documents and information as may be prescribed. So apparently TRC, tax residency certificate, is not independently works. We do need a document which gives other information, which is 10F. For all the practical purposes, let's consider they are part of the TRC. So this is what the law says, that if you wish to claim the DTA benefit, you must give the TRC. You must give the tax residency certificate. In the current Act ITA 2025, the same provisions are given in section 159, subsection 8, that a certificate of his being a resident in any country must be given if the taxpayer wishes to claim the treaty benefit. But when it comes to the DTA, there are three-step evaluation we need to do before we conclude that DTA benefit is available to the taxpayer, and we will see each one of them. So first is statutory eligibility condition. So statutory eligibility condition is whether you have that TRC or not, whether you are a non-resident of that particular country and you are able to submit the tax residency certificate, that is along with form 10F. If yes, then we'll see, whether you qualify under the treaty for the benefit or not, because there could be certain conditions within the tax treaty which one needs to qualify. And even if both are met, one is able to give the TRC, there are conditions in the treaty which you are able to justify. Do these anti-abuse overrides, the anti-abuse provision that, or, the judicial anti-abuse provisions are applicable on you or not? So this three-step evaluation, three-step analysis is required before somebody concludes that the DTA benefit can be given to a non-resident. So let's focus on TRC first. We have a press release dated 1st March 2013, which very much upheld, or which very much gave the power to the TRC, and wrote, and it was written in that press release, that tax residency certificate produced by a resident of a contracting state will be accepted as evidence that he is resident of that contracting state, and income tax authorities in India will not go behind the TRC and question his resident status. So way back, almost 13 years back, the press release came wherein it was clearly stated that we will not go beyond TRC, we in the sense income tax authorities. And we started relying upon TRC, and we are still relying upon TRC. But good or bad, the law has evolved. Also, in 2000, April 2000, with regard to specifically to Mauritian tax authority or Mauritian DTA, the circular was issued that it is hereby clarified that where a certificate of residence is issued by the Mauritian authorities, such certificate will constitute sufficient evidence for accepting the status of residence as well as beneficial ownership for applying the DTAC, that is the tax treaty. So now you see, the circular and the press release both have admitted that TRC is the final document, and if you are submitting the TRC, we will not go beyond that, and it would be considered as document of proof that the non-resident is a resident of that particular country. Now, jurisprudence also favored in the TRC. So we have a Delhi High Court judgment, recent Delhi High Court judgment in the matter of Blackstone Capital, wherein the court observed that TRC is statutorily the only evidence required to be eligible for the benefit under the DTA. So Delhi High Court also said that if you are giving the TRC, if non-resident is giving the TRC to the tax authorities in India, that's it. One need not give any further document, and the Indian tax authorities cannot go beyond TRC. Also, we have a similar judgment by the Bombay High Court in the matter of Alibaba.com, which upheld, the Bombay High Court upheld the decision of the ITAT, wherein the ITAT observed, the ITAT rejected the submission of the revenue relying on Vodafone International Holdings, that the IT authorities have blanket power to negate or ignore the tax residency certificate. So this is what, the ITAT of Mumbai upheld, that IT authorities does not have a blanket power to negate or ignore the tax residency certificate, which was later on upheld by the Bombay High Court. So both Delhi High Court and the Bombay High Court ruled in favor of TRC, that TRC is the final document and tax authorities cannot go beyond TRC. But if we go to the Vodafone International, which was referred by the Bombay High Court, also by the ITAT, also in this Alibaba.com. Let's read what Vodafone International says. It says, however, if the fraud is detected by the court of law, it can pierce the corporate structure, since fraud unravels everything, even a statutory provision, if it is as stumbling block, because legislation never intend to guard the fraud. Certainly, in our view, TRC certificate though can be accepted as a conclusive evidence for accepting status of resident as well as beneficial ownership. For applying the tax treaty, it can be ignored if the treaty is abused for fraudulent purpose of evasion of tax. So the Honorable Supreme Court very clearly said that TRC will not be considered as a final document if there is a fraud. So if somebody is abusing the tax treaty, if somebody is doing the fraud, creating a structure just to get the benefit of the tax law or get the benefit of the DTA, the Vodafone, the Supreme Court in the matter of Vodafone very clearly said, in such case, the TRC can be ignored. Now, let's see the recent Supreme Court judgment in the matter of Tiger Global, which is very much talked about. And I think after Azadi Bajao Andolan, though Apex Court has given a lot of judgments, but for an international, the students or the professionals who are working in international tax, I think this would going to be one of the landmark judgment which must be read in full. So what Supreme Court observed in this Tiger Global, that no doubt the provision of Section 4 and 5 of the Act are expressly made subject to the provision of the Act, which would include Section 90. The judicial consensus in India has been that Section 90 is specifically intended to enable and empower the central government to issue notification. However, the amendment subsequent to Vodafone to chapter and the insertion of Chapter 10A, this is the GAAR provision, General Anti-Avoidance Rules, the amendment to Rule 10U, the Double Taxation Avoidance Agreements, have completely changed the scenario. Circular issued earlier, we saw there were two circulars issued, one in the case of Mauritius, and then there is a press release. So what they are saying, the Apex Court is saying now these circulars do not hold value. After the amendment has come into effect, there can be no doubt whatsoever that TRC alone is not sufficient to avail the benefits under the DTA. And reliance upon earlier judgments dealing with circular issued in the pre-amendment regime cannot is perfecto come to the aid of the respondent. Rather, the fact will have to be independently analyzed to decide on the applicability of Chapter 10A. So very clearly, the Apex Code has said that now the TRC is not the final document. TRC is required. We must submit the TRC. We must take the TRC from the non-resident. But is it sufficient? the court says, the apex court says it is not sufficient. And based on this apex court judgment, recently the Delhi IT in the matter of Aaron Solar also observed the same. It says it is claimed that the SSC holds TRC issued by Singapore revenue authorities, and hence the SSC would be entitled or eligible to tax benefit under India Singapore DTA. It is now well settled that mere holding of TRC is not sufficient. So further, the authorities have to see surrounding facts and circumstances with respect to the claim of the taxpayer for residency based on TRC, and to make inquiries to see whether the claim of residency based TRC is genuine or merely a sham claim tainted by a misrepresentation or fraud. So now, from an era of Azadi Bachao Andolan, wherein treaty shopping was considered sort of a legal valid thing, and TRC was considered as the final document, we have moved on to an era of uh, Tiger Global, wherein TRC is not a final document, and the tax authorities can have a look through approach. They can analyze the structure, they can analyze whether you are abusing the treaty or not, or you are creating any fraud structure or not, just to get the benefit of the tax provisions in the either under the Income Tax Act or under the DTA. So that is a major shift which has happened, and in between we will see the BEPS provision also pitch in. The OECD carried out a base erosion and profit shifting project, because of which also there are changes in the treaty. We're going to see it shortly. So the conclusion is TRC is necessary but not sufficient. Now, if we see the treaty entitlement condition, if from the Act we move on to the Double Taxation Avoidance Agreement or the tax treaties, broadly, the one can claim the treaty benefit if one is the resident of that treaty of that country. And TRC is a good valid document to prove that yes, I'm a resident. So to start with, but it can very well happen that a person is resident of both the contracting state, let's say India and Singapore, then the tiebreaker rule will apply. And wherever the tiebreaker rules are, moving in the favor of India or Singapore, then it would be considered as finally the tax resident of India or Singapore in our example. So again, not though the person was carrying a TRC, but because of the tiebreaker rule, there could be change in the position. Also, you will see that you may be carrying the TRC, but there are beneficial ownership provisions in the DTA. So beneficial ownership provisions are generally with regard to the passive income like dividend, interest, FTS, fee for technical services, and royalty. So these are transaction specific. And if somebody is not beneficial owner, somebody is just an agent or conduit, then that benefit may be denied to that person. Now, recently, we will see that, in many of our treaties, limitation of benefit clause and principal purpose test has been added. So LOB, limitation of benefit and principal purpose test, is basically because of the base erosion and profit shifting. So the OECD observed while carrying out a project that one of the main reason for base erosion, one of the main reason for tax avoidance or paying low tax is the treaty shopping, is the treaty abuse. And in order to stop that treaty abuse or in order to control that treaty abuse, they brought in the provisions of LOB and principal purpose test. Now let's go one by one. Let's see what beneficial ownership provisions talk about. I'm not covering the resident part, the tiebreaker rule and the resident. I'm strict going on beneficial ownership, from beneficial ownership to this LOB clause, limitation of benefit, and then to principal purpose test, and then moving on to GAAR. At the end, we will be also discussing briefly about the Tiger Global Judgment. What are the facts and the observation of the Honorable Supreme Court in the Tiger Global Judgment. So the term beneficially owned appears in DTA mainly in provision allocating the taxing right to passive income that we discussed earlier, that dividend, interest, royalty, and FTS. It's basically to protect, that if there is any agent or nominee, so there could be a nominee who's just holding the share on behalf of another, and he does not have a control over the dividend income, or he does not carry any rights. So now that person is nominee, and being a nominee, he's not a beneficial owner. So in that case, he would not be entitled to get the benefit of that tax treaty. So what constitutes beneficial ownership? We have a judgment of the Mumbai Tribunal in case of Tenwala Trading, which says a person is said to be beneficial owner of shares when they are held by someone else on his behalf, meaning thereby that the registered owner is different from the actual or the beneficial owner. Where the shares are not so held by one or and on behalf of another, the concept of beneficial ownership cannot be invoked. So generally, we'll find that in case of agents or nominees or conduit, a company which is holding a share does not have control over the income, does not have right with regard to income and with regard to shares, and they are just holding for an administrative purpose. If that is the case, that is the fact, then the beneficial owner is not the actual owner of the shares. It is someone else. Now, if we go back to circular number 789, in case of Mauritian authorities, so it was not only with regard to the residential status, but it was also with regard to the beneficial ownership. Let's read it again. It says, it is hereby clarified that where a certificate of residence is issued by the Mauritian authorities, such certificate will constitute sufficient evidence for accepting the status of residence as well as beneficial ownership for applying the direct tax avoidance contract. So the certificate of residence was also, the TRC was also considered as not only the document to prove the residential status, but also the document to prove the beneficial ownership, that yes, I am the beneficial owner of this income, and I must get the benefit of the tax treaty. And the circular was upheld by the apex court in the matter of Azadi Bachao Andolan. Now let's see what is the current jurisprudence. We'll take up the matter by Chennai Tribunal in case of World Part Limited. The taxpayer is a company incorporated as Cyprus and a tax residence of Cyprus. The taxpayer invested share funds into the Indian company, fully convertible debentures. The assessing officer treated shareholder as beneficial owners of interest income earned from FCCD and denied the treaty benefit to the taxpayer, that is the company. So shareholders, they invested in the company, in the Cyprus company. Cyprus company invested in the FCCDs in Indian company. So the tax officer said the shareholders are indeed the beneficial owners and not the Cyprus company. So what is the view of the tribunal? The term is used to mean the entity which is the legal owner of a property and who has dominance and control over the property. The mere fact that investment was funded out of the portion of interest-free shareholder loan and share capital does not affect the appellant status as beneficial owner of interest income, because the entire interest income was the sole property of the appellant and was at its disposal. So the important point which tribunal noted, that the company which is receiving the money in Cyprus has got the full control over the disposal of income. And being the Cyprus company has got the control over disposal of income, Cyprus company would be treated as the beneficial owner and not the shareholders of the Cyprus company. In order to bring the theory of beneficial owner, the important fact needs to be considered is the recipient does not have full right to use or enjoy the interest, and that it receives, and this interest is not its own. If the recipient of interest income is a beneficial owner of that interest, where he has full right to use and enjoy the interest unconstrained by a contractual legal obligation to pass the payment, received to another person, the person who receives is the real beneficial owner. So when you are paying an interest to any other party or royalty to any other party, the question comes whether that party is a pass-through entity, he will collect and give it to someone else, or his own board, his own shareholders will going to take a call that how to deploy this fund. If it is a back-to-back transaction through some agreements, then it would be tough to say that recipient, the immediate recipient, is the beneficial owner. Then there can always be an argument that immediate recipient is not the beneficial owner, rather the beneficial owner is someone else. Let's see another judgment. It's an old judgment by Bombay High Court in the matter of Universal International Music BV. The SSC part of Universal Group dealt in music rights under the group's model. Rights were acquired from artists, repertoire companies, and transferred within a group. So there used to be, there were companies who will enter into the agreement with artists, and then these companies, repertoire companies, they will transfer the rights to some another company. In this case, the rights got transferred to the Netherlands companies. So the question was, the royalty which Netherlands company will be receiving, can we say that Netherlands company is the beneficial owner? Let's see what Bombay High Court said. Bombay High Court said, therefore, in our view, based on such certificate TRC, the SSC has to be treated as beneficial owner of royalty, even if no agreement with repertoire companies regarding acquisition of rights by the SSC had been filed. Therefore, the additional ground raised by the revenue is of no consequence, as tax residency certificate is a sufficient evidence of the beneficial owner as per circular CBTT. So can you see, that in the old era, 10 a decade before, a lot of reliance was placed on the CBTT circular. Even the apex court in the matter of Azadi Bachao Andolan said, a TRC would be considered as a sufficient proof, not only for the residency, but also for the beneficial ownership. And the same observation, same judgment was used by the Bombay High Court in the matter of Universal International Music BV. But are things changing? Yes, things are changing. We will see how things are changing. We'll move forward. So now coming to the treaty abuse, the BEPS project, which is changing the international tax scenario. Traditionally, we see the tax treaties, they were primarily drafted to avoid the double taxation. The objective was not to combat the non-taxation. So there used to be structures wherein India is not taxing the transaction. Even the resident country is not taxing the transaction. So transaction is not getting taxed at any point, nor at source, nor at the residence point. Because of which this kind of benefits, a lot of structures came in the picture, a lot of letterbox entities came into the picture. And I'm sure, we would be aware of such letterbox entities where maybe the companies have just created a letterbox entity to park their fund. They don't have employees, they don't have asset. Maybe one resident director is managing the entire show in a foreign country, and a lot of incomes are getting transferred to those entities. It might be a case, let's say the services are rendered from an X location, but the invoicing is done from a Y location. So X, let's say you have a team sitting, maybe at Y location and X location. Let's say teams are sitting in the X location. But for all practical purposes, for all billing that needs to be done to a client, you are using your Y location to raise an invoice on the client. And there is a back-to-back agreement from Y to X for the services. Now, the purpose of Y is what? The purpose of Y is not to render services, because Y does not have any employee with them. So why is only a letterbox entity, maybe one accountant is sitting who is just issuing the invoices and collecting the money? So now we have a limitation of benefit principal purpose test, and there is a change in the preamble to take care of this double non-taxation stuff. So India is a signatory to MLI, and most of the agreements are covered tax agreements. There is an Article 7 which talks about PPT, principal purpose test, and India has notified almost 90 plus DTAs as covered tax agreement via MLI. Now let's see limitation of benefit and principal purpose test. First, let's discuss the limitation of benefit clause, which is there in the treaty. Limitation of benefit clause is basically, uh, it says, the benefit of the treaty would be available to qualified person. If you are meeting these following conditions, you would be regarded as the qualified person and you would be eligible to claim the benefits of the treaty. Now, this LOB clause may be with regard to the entire treaty, but generally it's with regard to certain income, specified income on which this LOB clause operates. India also, because of the MLI, they amended their act. And if we see, sorry for my throat, if we see section 91 of the old act, and the same changes are there in the new act also, it says for the avoidance of double taxation of income under this act and under corresponding law in force in that country or specified territory, as the case may be. Now, this has been added recently without creating opportunities for non-taxation or reduced action through tax evasion or avoidance, including through treaty shopping arrangements aimed at obtaining relief provided in the said agreement for the indirect benefits to residents of any other country or territory. Now, the our very act says that the purpose of entering into the DTA is to avoid double taxation, but not to create an opportunity for non-taxation or reduced taxation in the cases of treaty shopping. Now let's see, we have a LOB clause in India, Singapore DTA. Let's read it quickly. We will not go into the clause too much, but just to give you the glance, what are the factors we need to consider before giving the treaty benefit. So a resident of a contracting state shall not be entitled to the benefit of paragraph 4A or 4C of Article 13. Article 13 is with regard to capital gain of this agreement if its affairs were arranged with the primary purpose to take advantage of the benefits in the said paragraph 4 or 4C of Article 13. So if the primary purpose is to take the benefit, if you have created a structure or conduit to take a benefit of 4A of the capital gain provisions, then in such case, you will not get the benefit. A shell or conduit company that claims it is a resident of a contracting state shall not be entitled to the benefit of paragraph 4A or 4C. So very clearly, if you are a shell company or a conduit company, this is the treaty clearly says you will not get the benefit. And what constitutes a shell or a conduit company, they have given a threshold that a resident of a contracting state is deemed to be shell or conduit company if its annual expenditure on operations in that contracting state is less than Singapore dollar 200,000 and Indian rupees, it's 50 lakh, 5 million in India, as the case may be. Then there are the following companies which will not qualify as shell companies if you are listed. So the point is, we do have, this LOB clause in the treaties, and before simply reading the FTS clause or a capital gain clause, it is advisable to identify the limitation of benefit clause and read it. If we see the India UAE treaty, it also has the LOB clause, which says an entity which is a resident of a contracting state shall not be entitled to the benefit of this agreement if the main purpose or one of the main purpose of the creation of such entity was to obtain the benefit of this agreement that would not be otherwise available. The case of legal entities not having bona fide business activity shall be covered by this article. So if you have an entity in UAE and one of the main purpose is to claim the treaty benefit and you do not have economic substance in UAE, or you are not carrying out any activity in UAE, but only building is only transferring the income, then the treaty says you will not get any benefit. So whenever somebody comes to us, to create a structure that the people are opening company in UAE for the transactions in the EMEA region, they would be transferring, they would be doing transaction and parking some profits. We always say that one needs to be cautious about the changes in the law, because if the tax authorities will pick it, they will going to certainly hit you. And many a times when you ask how many people you have in UAE, Singapore, the answer is not very positive. Let's read India Mauritius DTA. A resident of a contracting state shall not be entitled to the benefit of Article 13(3)(b). So this, if we see India UAE treaty, the LOB clause applies to entire treaty. But if we see India Mauritius treaty, it is only applicable on Article 13. Similarly, when we see the India Singapore treaty, it was only applicable on Article 13. A resident of a contracting state shall not be entitled to the benefit of Article 13(3)(b) of this convention if its affairs were arranged with the primary purpose to take advantage of the benefit in Article 13(b) of this convention. A shell conduit company that claims it is a resident of a contracting state shall not be entitled to the benefit of 13(b) of this convention. A shell conduit company is any legal entity falling within the definition of resident with negligible or nil business operation. So Mauritius is also saying the same stuff. So it's become very important that when you are working on any structuring transaction or when you are remitting payment to a foreign country, and if you if you want to give them a treaty benefit, I think not only the TRC, one must analyze the limitation of benefit clause and we have seen earlier the beneficial ownership clause. So these are more of an objective type, that if you are doing this much of an expense, then or income, you would not be treated as shell or conduit companies. Let's see this judgment. Heron Solar Singapore. I mentioned it earlier. It is by the Delhi ITAT. Let's see what were the facts and what was the observation of the tribunal. So Heron Solar Singapore was incorporated in Singapore in April 2015. It was a wholly owned subsidiary of Heron Solar Company Limited, Hong Kong, which in turn was wholly owned by Heron Solar Technology China. So a Chinese company was owning 100% in the Hong Kong company. A Hong Kong company was owning 100% in the Singapore company, and Singapore company invested capital in Indian company Renew Solar Energy Karnataka in both equity shares and compulsory convertible debentures. In June 2019, it took exit from the Indian company and made a profit of 17.67 crores. They claim that the under the India-Singapore DTA, there is a benefit available of the grandfathering, and there should not be any tax, long-term capital gain tax on 17.67 crore, which they earn. Now, the issue which came in front of the ITAT was LOB clause, whether limitation of benefit clause is applicable or not. Can we say it is a shell or conduit company? Or should we place reliance on the tax residency certificate or not? What ITAT observed? The tribunal observed that in FY 2019, the SSC activities were linked to divestment gains, CCD interest, and preferential redemptions with no operational business. Which SSC? Our Singapore company. The only expenses were administrative, professional fee, indicative of a shell entity rather than an active business. So what the tribunal observed that the entity in Singapore is doing a bare minimum spend, some administrative and professional fee. They do not have any employee. It's like a shell company. As of in June 2015, the taxpayer had 4 directors with only one based in Singapore, which is the requirement of Singapore law. Crucially, its HSBC Singapore bank account was operated by signatories from the US and Taiwan, with none from Singapore, indicating that financial control was exercised outside Singapore. So there were no employees, even the directors who were there, they were controlling the financial control, operations, and the Singapore director was not having any right. So it was only to fulfill the condition which was there in Singapore to open a company. The tribunal found no evidence of Singapore-based management, no travel records, authenticated minutes or expense documentation, and no substantive board deliberations. So everything was on piece of papers. There was no actual conduct which is happening. So it's just that, it is kind of they opened a company in Singapore and they started doing the transaction. They started routing the investment without any substance, without any manpower. And this does not happen in the actual world. So the ITT concluded the meetings were merely on paper with actual control exercised elsewhere. Having said this, the ITET said the TRC cannot be relied upon. They invoked the LOP limitation of benefits and denied the treaty benefit to the Heron Solar Singapore entity. Now moving on to the principal purpose test, it is again, I will say, a product or a byproduct of BEPS project. As per Action 6, treaty shopping as a key, the OECD analyzed or evaluated that treaty shopping is a key BEPS risk, and the PPT was set as a minimum standard. The Action 6 was set as a minimum standard, wherein the preamble language was changed. There were more effective anti-treaty abuse rule in form of the principal purpose test, with or without LOB, with or without limitation of benefit. So you might find treaties wherein you have only the PPT, or you might find treaties wherein you have PPT plus limitation of benefits. Let's see a few of the Indian tax treaties wherein we have the principal purpose test is there. So India-Cyprus, it is there after Article 28. You may see the synthesized text, which is published by the Indian tax authorities. In that text, you will see after Article 28 that the principal purpose test is given. Notwithstanding any provisions of the agreement, a benefit under the agreement shall not be granted in respect of an item of income if it is reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining that benefit was one of the principal purpose. So now PPT does not say that the main purpose or the only purpose should be tax benefit. It says one of the principal purpose. If tax benefit, then the PPT can be invoked. And in that case, one will not get the treaty benefit of any arrangement or transaction that resulted directly or indirectly in that benefit, unless it is established that granting that benefit in these circumstances would be in accordance with the object and purpose of the relevant provision of the agreement. So means if let's say, you find that, for example, Middle East, UAE has got favorable treaty, but you want to establish entity in UAE, not only for the tax benefit, but also for, let's say, for actual business reasons other than tax. In that case, you can still claim the treaty benefit. But if the only objective of establishing company in UAE, or let's say, in addition to that UAE has got some favorable location, wherein the shipment can be done. But if you could have done it, you could have managed without establishing a company in UAE, then I think the tax authorities can always challenge and say that you have established company in UAE in order to claim the tax benefit, and this is your principal purpose, and we will deny the treaty benefit to you. We have similar PPT in India Singapore DTA. So we have seen that we have India Singapore DTA, we have seen the LOB. Now there is a principal purpose test also. So in Singapore Treaty, we have both LOB plus PPT. What it says, notwithstanding any provisions of the agreement, a benefit under the agreement shall not be granted in respect of an item of income if it is reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining that benefit was one of the principal purpose. So pretty much the language is same. We have circular number 1 of 2025 on the principal purpose test, which says the treaty benefit denied if one of the principal purpose of an arrangement or transaction is to obtain the tax benefit. There could be PPT inclusions through negotiation or through MLI. This is on the applicability of MLI. We can skip this for now. The grandfathering provision has been given to India Cyprus, India Mauritius, India Singapore treaties. Let's see the judgment in the Sky High Appeal. It's very interesting judgment by Mumbai Tribunal, which basically defeats the PPT for now. So what it says, if you remember, we have got the Supreme Court judgment in the matter of Nestle SA, wherein the Supreme Court said that if there is any MFN clause or any beneficial clause there in the protocol, then it needs to be separately notified by the tax authority. So unless that is separately notified, it will not become applicable. Similarly, the ITAT in this case also observed that though MLI has been notified, but India Ireland DTA has not been separately notified to consider the MLI changes. And being it has not been separately notified, the MLI cannot be read in the DTA. Let's read. In our considered view, the factual metrics of the present case bears a close parallel to that examined by the Honorable Supreme Court in Nestle SA. In that decision, as in the matter before us, the original bilateral tax treaty, in this case, the India-Ireland DTA, stood duly notified. Equally, the subsequent MLI had also been formally notified. The pivotal question, however, was not that mere existence of notification in respect of both instruments, but rather whether the consequential modification of the earlier DTA brought about by virtue of the later MLI had itself been separately notified. So the ITAT said it has not been separately notified, and being it has not been separately notified, the PPT would not be applicable. The matter is now in the Bombay High Court. If you want to know my view, I feel we should read PPT in the law, because tomorrow, if any law changes, tomorrow, whatever the judgment may be, the High Court may say that, we need to have a separate notification. Then probably India will bring some clarification in the act and will say, it is applicable from the back date. So why to take a risk? So one should start reading the MLI provisions in the DTA while doing any structuring or while doing any transaction. Now we are on the last part of our presentation. So we have General Anti-Avoidance Rule in our Act, Section 95 to 102 of ITA 1961 and 178 to 184 of ITA 2025. So GAAR provisions are applicable in case of impermissible avoidance arrangement. So if one of the main purpose is, if the main purpose or one of the main purpose is to get the benefit, and the arrangement is at the non-arm's length scenario, which results in misuse or abuse of the act, which does not have a commercial substance and is carried out not in a bona fide matter, then the arrangement can be classified as impermissible avoidance arrangement. And if arrangement is classified as impermissible avoidance arrangement, in that case, one will not get the treaty benefit. Now let's see the Tiger Global International Holdings, the Apex Court judgment quickly. Assessee, a Mauritius-based investment entity of Tiger Global, they invested shares in the Flipkart Singapore. Flipkart Singapore was holding the shares in the Indian entity, which were transferred to the Walmart. There was a capital gain coming up in the Singapore entity because Singapore entity was driving value from India. So it was held that the gain which is coming on sale of shares of Singapore entity is taxable in India. So revenue set, indirect transfers provision kicked off, GAAR kicked off, and substance over form kicked off. So what the Apex Court observed with regard to TRC, GAAR, and JAR, let's see. So in para 37, the court said the section 90 subsection 4 of the act only speaks of TRC as an eligibility condition. It does not state that a TRC is sufficient evidence of residency, which is slightly higher threshold. The TRC is not binding on any statutory authority or court unless the authority or court inquires into it and comes to its own independent conclusion. So the Apex Court said TRC is not the final document, very clearly in the Tiger Global. With regard to GAAR, the court said there is no dispute that GAAR is applicable to the assessment year under consideration. An arrangement, the main purpose of which is to obtain a tax benefit and which inter alia is entered into or carried out by means or is a manner which is not ordinary employed for a bona fide purpose. So there was no logic beyond tax to invest money from Mauritius to Singapore and from Singapore to India. They could have done it directly. Observation on JAR that the GAAR operates independent of JAR, or the GAAR operates independent of the benefits or the PPT or LOB. The court said in the alternative, even if GAAR is held to be inapplicable, the revenue invoked JAR grounded in the doctrine of substance over form. So in that case also, it was contended that JAR continues to operate in parallel with GAAR and empowers Indian authorities to deny treaty benefit in case involving treaty abuse or conduit structure. So now the law is very clear that if there is a treaty abuse, if there is a conduit, if there is a fraud, then certainly one will not get the treaty benefit. Now we can take few questions if you have, if you wish to contribute something, feel free to do that. So you may raise your hand and then we can unmute you. I think
गौरव गौरव
yes. Yes.
हाँ जी गौरव सो हम लोग जनरली कैसे डिसाइड करें जब भी कोई क्लाइंट हमारे पास आता है फॉर इशूइंग 15 CB सो हाउ कैन वी गेट इनटू दैट लेयरिंग कि हमें ये बताओ कि आपकी कंपनी जिसको आप हम पेमेंट करने जा रहे हैं वो एक्चुअल में उस चीज़ की बेनिफिशियल ओनर है या नहीं है फॉर एग्जांपल Salesforce, if you heard of this company,
Mhm.
so Salesforce has locations in multiple countries, right? So they generally raise an invoice from a country with which India has an agreement by which it says कि FTS जो है वो नहीं लगेगा
Hmm.
जबकि एक्चुअल में काम हो रहा है और Salesforce किसी और कंट्री में हेडेड है सो ऐसे केसेस में फिर कैसे करें डिटरमाइन
Sir, as a chartered accountant, I
या
think.
सैप या जैसे हम कहें सैप सो सैप के सर्विस प्रोवाइडर्स हैं जो सैप इम्प्लीमेंट करवाते हैं राइट सो देर आर मल्टीपल कंपनीज फ्रॉम मल्टीपल कंट्रीज विच आर फैसिलिटेटिंग सैप इम्प्लीमेंटेशन सो इफ दे से कि सैप की हमारी ये वाली कंट्री की जो ब्रांच है उसने इंडिया में सर्विस दी है इसलिए जो टीआरसी मतलब ये टैक्स नहीं लगेगा इस पे सो उन चीज़ों को कैसे करें हम एड्रेस
I think, sir, very valid question, Ashish ji, and it is really tough to identify, especially in case of these cloud companies, कि जिसको हम पे कर रहे हैं वो मतलब जेन्युइन वहां पे उसका बेस है या इट्स ओनली अ बिलिंग एंटिटी. आई थिंक what at best we can do, we can ask questions from the taxpayer कि that you need to get the following clarification from the foreign entity, whether it is a shell company or a conduit company, or they how many, what is the manpower, what are the rights they have in that country. But I think it's tough, especially in case of cloud companies. I do agree. But if you have this kind of a questionnaire which you have issued to a non-resident and he has relied upon, then you have a possibility of performance issue. You cannot go beyond that. You are not investigator. So based on the basic documents, basic clarification from the non-resident, I think we can issue the certificate.
अब ये
Yes, Nikhil.
जो वेरिफिकेशन है, ये तो कोई लेन देन नहीं देता है। मैं तो क्लाइंट कहेगा भैया ये है, टीआरसी मांगी, उसने नो पी दे दिया, टीआरसी दे दिया, 10F दे दिया, व्हाट एल्स यू नीड। सो
सर अभी तक तो यही होता था. आई डू एग्री.
बहुत एग्रीमेंट मांग लेते हैं फिर भी कि कोई एग्रीमेंट है तो दे दो। सो कुछ जगह जहाँ एग्रीमेंट होता है वहाँ दे देते हैं, बट ऐसे केसेस में कोई एग्रीमेंट भी नहीं होता है, बिकॉज उसको भी बहुत घूम घाम के करना पड़ता है। एंड सेकेंडली जो ये दुबई वाला जो एग्जांपल है,
हम्म.
multiple IT companies are there. Indians have opened IT companies there and raising a billing there from here to Indian clients and seeking के, क्योंकि हम FTS के अंदर फॉल कर रहे हैं तो वहाँ पे DTAA के हिसाब से टैक्स नहीं बनता है, जबकि काम सारा जो है वो इंडिया में कहीं ना कहीं से हो रहा है, तो रिवर्स में वापस से बिलिंग होकर के चला जाता है। अब उन केसेस में एंड सिंस अब क्योंकि ओनर्स भी इंडियन ही हैं, हम ये नहीं कह सकते हालांकि कि बाय नेम सिंस यू आर एन इंडियन, सो
सर वहां पे कितने एम्प्लॉयज
शायद
हैं
तुम लोग
आशीष जी? वहां पे अगर
सर।
यूएई में आपके एम्प्लॉयज ही नहीं है, या एक डायरेक्टर है जो सब कुछ कर रहा है और बाकी आपने सारा किसी अकाउंटिंग फर्म को दे रखा है, तो मेरे हिसाब से इट इज अ हाई रिस्क केस, हाई रिस्क केस.
लेकिन सर ये तो जिस क्लाइंट को हम 15 CP सर्टिफिकेट इशू करने जा रहे हैं, वो तो हमें इतनी चीज़ें उससे मांग करके दे ही नहीं सकता है, देता ही नहीं है। क्या करें? वो तो कहता है ये एग्रीमेंट है, ये बिल है, पेमेंट कर दो, आप सर्टिफिकेट दे दो।
सर देखो, रिस्क तो है ही. मतलब अगर उसको पता है कि यूएई में मान लीजिए उसकी सारी बातें इंडियन बंदे से हो रही हैं, इंडिया में हो रही हैं, एंड ओनली इनवॉइस इज कमिंग फ्रॉम यूएई, ये फैक्ट अगर आपके क्लाइंट को पता है, देन ऑल्सो इज रेमिटिंग अ पेमेंट एंड गिविंग द डीटीए बेनिफिट, आई थिंक ही इज क्रिएटिंग प्रॉब्लम फॉर हिमसेल्फ. सो बिकॉज पेनल्टी प्रोविजंस भी उस पर किक ऑफ हो जाएंगे. तो मुझे तो लगता है कि हाई रिस्क मैटर है ये, एंड द पेयर्स नीड्स टू बी कॉशियस फॉर these kind of transactions if they are making a payment to any entity outside India, which they themselves are clear that ये डमी एंटिटी है एंड ऑल सर्विसेज आर प्रोवाइडेड फ्रॉम इंडिया. कई बार होता है कि मान लीजिए फॉर एग्जांपल मैंने आपसे सर्विस ली या मैंने आपको सर्विस दी और मैंने आपको कहा सर बिलिंग मेरी यूएई एंटिटी कर देगी. यू आर अवेयर ऑफ दिस. आई थिंक एट दैट पॉइंट वन शुड रेज अ फ्लैग दैट बॉस मैं ऐसा इनवॉइस नहीं लूंगा. आई नीड इनवॉइस फ्रॉम इंडिया, वेयर इन वी आर नॉट अवेयर कि जो यूएई में एंटिटी है कहीं और एंटिटी है, वो कॉन्ड्यूट कंपनी है, शेल कंपनी है, पेपर कंपनी है. तो हमारे साथ भी फ्रॉड ही हुआ है. बट जनरली मुझे ऐसा लगता है कि बारिंग फ्यू केसेस बिजनेसमैन को पता होता है कि सर्विस कहाँ से आ रही है और बिलिंग कहाँ से आ रही है. निखिल, यस.
गुड इवनिंग सर।
गुड इवनिंग निखिल.
सर मेरा क्वेश्चन पीई के रिलेटेड ही है। जैसे इंडिया में लोग दुबई में कंपनी खोल लेते हैं या यूएस में $1 कंपनी खोल ली, बट सारा वर्किंग यहीं से चलती है। तो इस केस में जो यूएस में कंपनी है तो उसकी पीई यहाँ पे इंडिया में एस्टैब्लिश हो सकती है?
यहाँ निखिल पी ना अलग मैटर है. अ, हो भी सकती है, नहीं भी हो सकती, मतलब वो देखना पड़ेगा. मतलब उसमें ना अलग डिस्कशन, कभी पी पे सेपरेट डिस्कशन कर लेंगे. बट अगर वहां पे सिर्फ पेपर कंपनी और सब कुछ इंडिया में हो रहा है, तो पोएम भी ट्रिगर हो सकता है और पी भी ट्रिगर हो सकता है।
ओके,
दोनों चीजें ट्रिगर हो सकती है।
ठीक है।
सुनील, सुनील ठाकुर जी।
सर गुड आफ्टरनून।
गुड आफ्टरनून जी।
सर मैं कह रहा था कि अब 10F तो जैसे मैंडेटरी कर दिया ऑनलाइन 2023 से, तो अब टीआरसी की अब भी कोई वैलिडिटी रहेगी? क्योंकि 10F में तो वो टीआरसी अपलोड करा ही लेते हैं और मतलब 10F ले ही लेते हैं।
सर मैं तो कहूंगा कि आपका बात ठीक है, वो 10F में आ जाता है, बट सेपरेटली भी ले लो। क्या दिक्कत है मतलब लेने में?
हम्म।
आपके पास होना चाहिए। देखो 10F के साथ अटैच करके अपलोड होता है। और अगर आपके पास टीआरसी आ रहा है तो ठीक है, कोई दिक्कत नहीं है। अगर नहीं है टीआरसी की कॉपी, क्योंकि जो टीआरसी उसने अपलोड करा हमें नहीं पता वो सही करा गलत करा। अगर इफ वी कैन सी व्हाट टीआरसी इज अपलोडेड एंड यू कैन डाउनलोड, आई थिंक देन इट इज गुड इनफ।
थैंक यू।
थैंक यू सुनील जी। ओके, एनी अदर क्वेश्चन?
Hello.
हाँ जी निसार।
Hi, Gaurav sir.
आई एम गुड निसार, हाउ आर यू?
I'm good. I'm good. Sir, I wanted to ask a question in connection with this limitation of benefit clause, wherein there was a Singapore company operating from Singapore, invoice was also raised from Singapore, but that company wanted us to remit the amount to USA. So they have provided tricky benefit, tricky documents also, TRC, no PN. So
Nisar,
in that case,
Nisar, your voice is not coming clear to me. It's breaking.
is it clear now, sir? Is it clear now?
It's slightly more loud. Can you be slightly more, bring your volume down and be slow?
Okay, okay. Am I clear now, sir?
Yeah, yeah.
Acha. There was a Singapore company who had provided services from the Singapore, professional services, and they have raised invoice also from the Singapore. But at
Singapore,
its full
there is a Singapore company which is raising invoice on Indian company.
Indian company, yes. But the issue is they wanted us to remit the amount to USA because the IBAN which they have provided is of USA.
Nisar, I'm not getting clarity on the facts. I would suggest we can discuss it offline. You can call me. You have my number.
No, sir. Can you please share it?
Sir, he's saying that the TRC is of say Singapore, but the remittance is requested to USA.
Okay.
Yes, sir. So in that case, will a limitation of benefit clause get triggered?
Yeah, I don't think, but if the remittance is going to
So
a US bank account,
whether
US
DTAA
bank
benefit
account belongs to the India. So let's assume you have a company in Singapore which is providing you the services. That Singapore company has got two bank accounts. One bank account is in US, one bank account is in Singapore. Now they are saying instead of making remittance to my Singapore bank account, you remit money to the US bank account. And based on this fact, if we wish to conclude that LOB clause may get triggered, I think this may not be the correct position. We need to see because see the remittance which you are making in US is also based on the direction of Singapore company. So it is not that that entity does not have a control over the money. That entity do have a control over the money, and they are only asking you to transfer the money to the US. The point comes whether the Singapore entity uh, is rendering you service or it is a mere a conduit or a paper company. So, Nizar, I would like, I would suggest that we need to evaluate more. This bank account fact may be a trigger or maybe a indication that you need to go more deeper into the transaction. But to conclude only based on this bank account fact, I think that may not be the correct position.
सर अगर क्लाइंट टीआरसी की एक्नॉलेजमेंट प्रोवाइड कर देता है इंस्टेड ऑफ टीआरसी, तो क्या उसको बेनिफिट दे सकते हैं डीटीएए का?
Acknowledgement मतलब?
एक्नॉलेजमेंट प्रोवाइड कर देता है कि उसने फाइल कर दी है,
नहीं
बट
नहीं,
अभी उसको रिसीव नहीं
अच्छा
हुई है।
उसने अप्लाई कर दिया टीआरसी
हाँ
के लिए
जी, हाँ
आप?
जी।
नहीं नहीं, लॉ तो कहता है श्वेता कि टीआरसी होना चाहिए। So there are two incidents which are happening. One is when you are remitting the money and then when he's filing the return. So in my view, when you are remitting the money, TDS, if you see the TDS provisions, TDS provision gets triggered at the time of booking of expense or creating a provision or making a payment, whichever is earlier. So now let's say you have booked an expense in February, you are remitting money in May 2006. So you need to deduct a TDS at what point in time? You need to deduct a TDS in February. So we need to see in February, do you have a tax residency certificate or not? And if you don't have the tax residency certificate in the February, then as a remitter, you cannot give the DTA benefit to the recipient. This is my view. In May, if somebody submits you the TRC, I think in February you have already deducted. Now we cannot go back and say, okay, kam kare, jada kare. In that case, the probable position would be that non-resident needs to file income tax return in India and claim a treaty benefit in the return and they get the refund. This could be the probably you know step by step this can happen. Gaurav is asking what other documents required apart from TRC to obtain DTA benefit. Gaurav, we have discussed this in detail. What things you need to see. So maybe I will try to create one slide on the documents that can be collected from a client to check LOB and other stuff. Yes, Vidhi, you want to say something?
Sir, yes, sir. I had one query. Sir, in case TRC, because US follows calendar year, so if TRC is valid till 2025, and now we are making the remittance, they have already applied TRC for the year 2026, but it has not been given. So on that very basis, can we?
Okay, so Vidhi, I think there is some judgment wherein the court or the tribunal observed that if there is a TRC for December available, December 25, let's say, it can be considered a valid document for the financial year 25-26. But I think you need to check this. This is what I broadly remember. And this practically what happens, if you have a TRC till December, till March, I think you can practically apply. But at the same time, ask client to give you the TRC for 26 also.
Okay, thank you, sir.
Thank you. So thanks everyone.
Sir, I have another query, if you could take it up.
Yes, Pankaj.
Yeah. So in case of imports of goods, say for example, the taxpayer is importing goods worth of rupees 10 crore in the financial year from a specific exporter based in China. So in that case, SCP provisions are retracted, I suppose, get retracted, I suppose. So in that case, to claim the DTAA benefits, do we have to, Form 41 is mandatory, right? Along with the TRC?
Yes, Pankuri, I hold the same view because if we only stick to the act, then act has got significant economic presence provision, which will get triggered if the value is more than 2 crore in an aggregate. Now, wherein the value is 10 crores, in order to avoid any litigation, it is better to take client to the DTA for which you need TRC plus Form 41 in the current act.
Yeah, and a no PE certificate for that. Yeah. Yeah. Okay, got it, sir. Thank you so much.
Gaurav, Sumit this side.
Thank you, Sumit bhai.
Just on the timelines of filing the TRC, any settled position, though there are judgments which are saying, including ITT, that there is no specific timelines in the Act itself. I'm not sure about the 25 Act, but at least in the old Act it is not there. And there are judgment in favor of the assessees that you can file the TRC even after claiming the benefits, and you can finally take the DTAA benefits. Any settled position, recent change or something?
Sumit, I can tell you my view, which is based on the Act. Act says that if you wish to give the DTA benefit, then you must submit the TRC and Form 10F or Form 41. Correct?
Okay.
Now, there are 2 points in the Act. One is when you deduct the TDS, at that time you evaluate the tax position. and
Mhm.
second, when you file the tax return. So let's say I am a payer and I need to make a payment to the non-resident.
Mhm.
I need to see whether I need to deduct TDS under the act or I can give the treaty benefit, because that's what the chargeability to tax means. I need to give the treaty benefit.
Right.
If I need to give the treaty benefit at the time of deduction of tax,
Mhm.
at that time I should have TRC with me.
Fair enough.
If required, Form 10F or Form 40.
Mhm.
But the final is, when the non-resident is filing the return of income. Now, if non-resident is filing the return of income, in the return, the non-resident can claim the DTA benefit. Now, when
Right.
he wished to claim the DTA benefit, when he is computing his own tax liability, at that time, if he is having a TRC, which was not there at the time of deduction of tax, I think he
Right.
can still claim the DTA benefit. That's what I understand. But if you have already filed the return and at that time you do not have the TRC, I think that could be a challengeable position. I do remember there is one
Mhm.
or two case laws which are in favor of the taxpayer, which says it is only the administrative requirement and not mandatory. But somehow, with the due respect, I do not follow those judgments.
No, I agree. So basically, in one of the transactions which actually, falling under the on an accrual basis, wherein the TDS has been deducted, or the WTA, WHT, on a higher rate, the full rate which was applicable in the absence of TRC. Now, whenever the client is expecting the TRC to be in place in maybe a couple of weeks, and the client will be, the non-resident, the client would be filing the tax return, and by filing the TAF. So I think then DTAA benefit can be claimed and as a refund that
इसके अलावा सुमित भाई कोई और ऑप्शन ही नहीं है. तो
right.
रिफंड क्लेम करो, बेनिफिट लगाओ,
Mhm.
देखा जाएगा जो होगा.
But उसमें 10F के लिए there is no time limit. So obviously it should be before filing the IT, right?
जो भी इंसिडेंट अगर डिडक्शन के टाइम पे करना है तो तब
Mhm.
भी होना चाहिए, नहीं है तो फिर रिटर्न के टाइम पे होना चाहिए.
Right. Thank you.
Thank you, everyone. Thanks for being a wonderful audience and joining this session. Learning is always mutual. So I learn from you and we are learning together. See you soon in the next session. Thank you. Bye-bye.